Welcome to the deep dive. Today, we are taking a really close look at Japan, drawing entirely from the latest analysis by Trading Post. There's been a pretty significant political shift, with Sanai Takaichi becoming the new prime minister. And the big question the bet investors are making, according to Trading Post, is this. Is Japan finally going for real, deep structural change? Or, well, is it just more of the same stimulus policies we've seen before?
Yeah, it's a pivotal moment, both politically and certainly from an investment perspective. Takaichi, she's backed by the Japan Innovation Party, which leans right, and she's made history,
Got it.
Japan's first female PM.
Yeah.
And she secured a solid majority, 237 out of 465 seats. That's significant. Trading Post sees this as potentially the political muscle needed for genuine reform.
Okay, and based on that potential, Trading Post has staked out a pretty clear investment view. They're saying overweight Japanese equities, specifically looking at industrials, capital goods, export cyclicals, and importantly, underweight Japanese government bonds, JGBs.
Right. And Trading Post read on the underlying business cycle, well, it's already paid off for them quite nicely this year. The Nikkei 225, up almost 22% since January. And the yen, surprisingly perhaps, has strengthened about 3.5% against the dollar. So that unhedged overweight call from Trading Post, based purely on those business cycle fundamentals, that's worked out well. It shows the market was already anticipating something positive, even before Takaichi officially took over.
So here's the really fascinating part, the core tension that Trading Post identifies. Takaichi openly admires Margaret Thatcher. She talks about structural reform, boosting competitiveness, but she's also deeply tied to Shinzo Abe and the whole Abenomics framework. So is it Thatcher's fiscal discipline? Or is it the big spending, the monetary easing we saw with Abenomics? Markets, as Trading Post notes, seem to be betting on the Thatcherite side right now, but, well, Takaichi seems pulled in two directions.
Exactly. And to understand that tension, we probably need to know a bit more about who she is. Born 1961, Kobe University graduate. She's not new to this. She's been a politician since 1993, held some pretty senior roles like Minister of Internal Affairs and, crucially, Minister for Economic Security under Abe himself. She was definitely an insider.
And her ideology is key to why the markets are excited, right? Trading Post points this out clearly. She's a staunch conservative, definitely pro-business, supports deregulation, market-based solutions, structural reforms, all the things aimed at finally getting sustainable growth going. That's why Trading Post uses the word swooning to describe the equity market's reaction. They like the sound of Thatcher-style changes.
But there's another side, too. She's also known for a, let's say, hawkish stance on foreign and security policy. Quite nationalist. She wants to revise Article 9, the pacifist clause in the Constitution, to formally recognize and expand Japan's self-defense forces. And we have to mention the visits to the Yasukuni Shrine. For listeners who might not know, this shrine honors war dead, including convicted war criminals. Her visits always cause friction, serious concerns, especially in Korea and China. So there's potential for geopolitical tension there.
Yeah, and that nationalism seems to feed directly into her economic security ideas. She's tough on China, supports closer ties with the U.S. and Taiwan. Trading Post highlights her wariness about being too dependent on Chinese markets, wants to build up Japan's own industrial base, protect key technologies, and maybe even tighten up immigration, talking about orderly coexistence.
Yeah.
Her very traditional social views opposing same-sex marriage, supporting male-only imperial succession, they kind of reinforce this image of a leader focused on conservative structural coherence.
Okay, so let's dig into that central policy conflict. Trading Post identifies Thatcher versus Abenomics. They really are quite different economic approaches.
Let's start with Thatcher. Trading Post really stresses the scale of what she did. It wasn't just trimming, it was, well, major surgery on the state. Small government, tight budgets, supply-side focus. She cut the top income tax rate, get this, from 83% down to 40%. Privatized huge state firms, British Airways, British Telecom, British Gas. Took on the unions, broke their power in many ways, and shrank the public sector workforce by about 700,000 jobs, something like 15%. Government spending as a slice of GDP, it fell sharply, from around 48% down to 39% between 82 and 90. That's a massive shift.
Then you have Abenomics, the system Takaichi knows well, having worked within it. Remember the three arrows. Aggressive monetary easing from the Bank of Japan, flexible fiscal policy meaning government spending and structural reforms, and Trading Post acknowledges there were real successes. Unemployment dropped significantly from 4.3% to 2.4%. Corporate governance got a major overhaul. The number of firms with independent directors went from just 22% up to 94%. And profitability improved too. Return on equity, ROE, went from around 5% up to nearly 9%. So not insignificant changes.
But hang on, here's the rub I'm trying to grasp. If Thatcher cut state spending from 48% to 39% of GDP, how can Takaichi possibly be loyal to both Thatcher and Abenomics, which relied heavily on that second arrow, flexible fiscal policy? Isn't Trading Post maybe a bit too optimistic here about how much Thatcher she'll actually deliver?
Well, that's precisely the tightrope she has to walk. It's the key test. Trading Post suggests she might be trying to pick and choose. So yes, she talks reform, but on the fiscal side, she's diverging completely from Thatcher. Takaichi actually supports more government spending focused on boosting domestic consumption. She talks about crisis management investment, putting money into strategic areas like semiconductors, AI, defense. She even floated the idea of taxing the big cash piles corporations are sitting on to force them to invest. Thatcher would have probably hated that idea. So it seems she wants Thatcher's results, the growth, but maybe without the really tough fiscal medicine.
Okay, so if the spending side is tricky, that makes the tax side, the structural reform side, even more critical. And Trading Post does suggest there's room for cuts that could align with both models, actually. Japan's corporate tax rate, around 30%, it's still pretty high compared to the global average, 23.5%, or the Asian average of about 19.7%. And the top personal income tax rate is up near 50%. So cutting those rates could be a clear signal, or a relatively easy win, perhaps, to show she's serious about the pro-investment path.
Right, but while this political balancing act is important context, Trading Post is really emphasizing that their core overweight call isn't primarily based on predicting Takaichi's exact policy mix. Their conviction, they say, comes from Japan's underlying economic strength, the business cycle fundamentals. They identify Japan as being in the middle of a classic, fixed investment-led juggler cycle.
Okay, juggler cycle. Let's break that down a bit for listeners. What does Trading Post mean by that dynamic?
Essentially, it's about the sequence. The corporate profit cycle picks up first. That then fuels the investment cycle. Companies start spending on equipment, factories, R&D, and that investment cycle, in turn, usually drives the credit cycle, borrowing, and lending pickup. According to Trading Post's analysis, Japan is firmly in that expansionary phase right now, and is being driven mainly by that corporate investment spending.
And Trading Post sees a specific kind of unusual pattern here, right?
Yeah, this is quite interesting. They point out that the credit cycle, think household borrowing, consumer confidence, it's actually lagging behind. It's either flat or even turning down slightly. Normally you might worry, but Trading Post interprets this positively. It suggests the expansion isn't built on shaky consumer debt or excessive speculation. It's being driven by corporate capital expenditure, which is generally seen as more sustainable, a healthier foundation for growth.
And the numbers back this up, this idea of internal corporate strength.
Trading Post says yes. Growth has apparently accelerated for 5 straight quarters now. Investment spending is looking robust. Exports are holding up surprisingly well, despite global headwinds. Even imports, which Trading Post watches as a leading indicator for domestic demand, they were up a solid 4% year-over-year recently. That suggests companies are still planning for future activity.
Okay, but there has to be a weak spot. Where does Trading Post see the risk?
The consumer. Definitely the consumer. That's the clear weakness they flag. So nominal wages, they are growing about 3.5% year over year, which sounds okay, but inflation is higher. So real wages, what people can actually buy, they're falling, down 0.8% in the latest figures for August. People's purchasing power is shrinking. And that's hitting retail sales volumes, which are contracting. This is the big challenge for Takaichi. She needs to address this squeeze on households if she wants to keep public support, especially if she tries to push through other, maybe unpopular reforms.
And this weakness in consumer spending, it must complicate things for the Bank of Japan, too. What's Trading Post's view there?
Yeah, it creates a dilemma. Headline inflation, while still present, is actually easing off a bit. It was 2.7% year over year in August. But because the credit cycle is weak, because households are hesitant to borrow and spend, the BOJ is kind of stuck. Trading Post expects them to keep the policy rate on hold, likely for the rest of 2025. Even though there's pressure to normalize policy to maybe support the yen, the weak domestic demand picture makes it very difficult.
Right, which brings us neatly to the constraints Takaichi is operating under. Especially if she has any genuine Thatcherite leanings towards fiscal discipline, Japan's debt is just enormous.
It really is. The debt-to-GDP ratio was around 236% just before the pandemic.
Yeah.
It's come down a bit since then, but the sheer scale is, well, daunting for any leader, let alone one potentially looking at fiscal consolidation.
And Trading Post highlights a specific structural issue with that debt, don't they? Who actually owns all those JGBs?
Yes. This is a crucial point in their analysis. A huge chunk, about 45% of Japanese government bonds, are held by the Bank of Japan itself. Another big slice, around 23%, is held by domestic pension and insurance funds. Now, the BOJ is gradually trying to normalize its policy, which means reducing its JGB holdings over time. That reduction, combined with general worries about whether Japan's finances are sustainable in the long run, has pushed up yields on 10-year JGBs. And Trading Post interprets this rise in bond yields as a key business cycle signal. They see it prompting investors, particularly those big institutional ones, to rotate out of bonds, which are losing value, and into equities, chasing the growth offered by that corporate investment cycle.
Okay, so the bond market dynamics seem to reinforce the equity call. But Takaichi's first moves, they don't exactly scream fiscal discipline, do they?
No, they don't. And Trading Post notes this with some concern, especially for those hoping for a purely Thatcherite approach. She's already announced a new fiscal stimulus package aimed at tackling inflation. The rumors are that it could be even bigger than last year's $13.9 trillion plan, which is already pretty substantial. Trading Post warns this looks worryingly like falling back on the old playbook: demand-side stimulus, public works projects, maybe consumer coupons, things that provided temporary boosts in the past but didn't really create lasting, market-driven growth momentum.
So despite those concerns about the immediate policy direction, Trading Post is sticking with its optimistic stance based on the cycle.
Yes, fundamentally, their core thesis remains intact. They seem quite confident about it. They believe the underlying strength shown by the business cycle indicators that juggler cycle, driven by corporate profits and investment, will likely carry the day, almost regardless of the short-term political noise or stimulus measures. For Trading Post right now, the health of Japan Inc. seems to trump the immediate policy choices.
And that conviction translates into specific sector preferences.
Exactly. They're maintaining that overweight stance, tilted heavily towards industrial stocks, capital-intensive sectors, companies making machinery, equipment, that sort of thing. And, interestingly, they remain positive on export cyclicals, which might seem counterintuitive given global trade worries. But Trading Post notes that Japanese exporters are proving surprisingly resilient. They argue this suggests the global trade cycle, particularly for the kind of capital goods Japan excels at, is actually stronger than many bears believe.
Trading Post also mentioned a near-term political event to watch.
Yes, Takaichi is apparently scheduled to meet with former U.S. President Trump next Tuesday. Trading Post suggests that a strong, stable U.S.-Japan relationship is generally positive for market sentiment, though they don't expect any major renegotiation of trade deals in the immediate future from that meeting. It's more about the optics and reaffirming ties.
Okay, so let's try and bring this all together. We started with this bet on Takaichi Thatcher or Abenomics.
Right. And looking back, Abenomics did achieve some things. It definitely restored some confidence, pushed through some needed corporate governance reforms. But, as Trading Post highlights, it didn't deliver that deep, fundamental structural transformation many hoped for. Japan was still left quite reliant on stimulus, both fiscal and monetary, and saddled with that massive debt load.
Which leads us to a final, maybe provocative thought for you, the listener, building on Trading Post's analysis. If Abenomics, in the end, lean too heavily on those fiscal and monetary arrows, maybe avoiding the hardest structural choices, what if Takaichi, genuinely inspired by Thatcher's radicalism, decides to actually pull back hard on that government spending and easy money? What if she focuses only on the tough supply-side reforms, the kind of painful medicine Abenomics arguably shied away from? Could that kind of shock, that uncompromising approach, be the very thing needed to finally unlock the kind of sustained, market-driven growth investors are pitting their hopes on Takaichi delivering? Something to think about.